think, Martine, I'm going to invite you to take that chair there. Your microphone is just on your left. Sir, if you could sit there. Your microphone is on your left. If you could sit there. Your microphone is on your left. Pedro from Allianz. Hi, welcome, sir. Let's just test your microphone. How are you doing this morning, Pedro?
1, 2, 3, 1, 2, 3. Very good. Thank you for having me.
Where are you from?
I'm from Spain, so I think I've been told I need to speak loud, so I think I'm in the right place.
That's true. Can you hear Pedro? Great. For those who are on the edges, feel free to come in. Welcome. And we've got Bart also. Hi, Bart. Welcome.
Hello.
Where have you traveled from today, Bart?
From Limpertsberg. It was a long commute, yes.
Well, very good to have you here, of course, representing ILPA.
Thank you.
Hi, Irina. Hi, welcome.
Hello.
Now, Irina, where have you traveled from today?
Amsterdam.
From Amsterdam.
Not that far.
Not too far. Of course, working for NN Group, and you're a senior portfolio manager, I believe. Is that right? And then our panel today is going to be moderated by the lovely Martine. Martine, welcome.
Hi, how are you?
Well known to the private equity community here in Luxembourg. We really look forward to hearing your questions and insights on all things to do with LPs. Ladies and gentlemen, the panel is yours.
Hi, everyone. It's very nice to be here on this 8th edition of the LPEA Insights. It's incredible how this has been growing over the last few years. And also happy to be able to moderate a panel that has a topic I have. So for my background, I'm a native Luxembourger. I have been in markets, financial markets, for 25 years. The majority of it in private equity in London. And I've been part of Advent International for the last 4.5 years, based here back in Luxembourg. Now, in those 25 years, I don't think I have seen markets where our topic has been so crucial, apart from financial crisis. So very pleased today to be joined by very distinguished guests. And so I think that I will let them introduce themselves.
Hi everyone, Pedro Alonso-Lamberti. I'm a portfolio manager at Allianz GI Private Markets. We are a subsidiary of Allianz Global Investors with 170 professionals scattered a bit all over the main financial jurisdictions. We have a team of 40 professionals sitting in Luxembourg. I'm part, as said, of the portfolio management team. We have also risk, fund operations sitting here, which I think credits that we really have a bet for Luxembourg. Allianz GI Private Markets has an overall portfolio of 116 billion dedicated to private markets. I would say the split is roughly 50% infrastructure, 30% private equity, 30% debt, 50% then 30% private equity, and 20% in renewables. Here we manage the third-party portfolio with an spectacular growth of the private credit specifically, but we have around 25 billion encompassing private debt, infrastructure, and private equity. Thanks.
Yes, good morning, everybody. Bart van Dijk from the Institutional Limited Partners Association. We're basically the global LP association, so we represent a very broad group of LPs ranging from pension funds, insurance companies, family offices, endowments, universities, fund of funds as well, in a group there as well. We have between 600 and 700 member institutions right now, which represent thousands and thousands of people in 50 countries around the world. And the thing we do actually is we focus a lot on transparency, creating alignment of interest between LPs and GPs, and focus on governance. And we try to be really practical between LPs and GPs, really helping with a lot of things. In terms of industry guidance, we put out a lot of kind of like papers and templates, basically help the ecosystem or the industry at large to understand current dynamics, trends. So at the end of the day, we can all make better investment decisions. I'm happy to be here. Thank you.
Hello, everybody. This is Irina Barbuntoiu, NN Group. NN Group is a Dutch insurance company with activities in Europe and Japan. On the investment side, we've been actively in public markets and private markets at the same time, investing the general account of our insurance business units, mostly life insurance and non-life. I am actually part of the private markets team, where we cover a wide spectrum of investments, from real estate to private equity, infrastructure, private debt, and mortgages. I'm responsible for the private debt portfolio, which many of you might think is the new private equity. And I'm very excited to be here sharing perspectives from an institutional investor side.
Thank you. So, interesting times we live in, between wars, between inflation, interest rate rises. More lately, it's been coming from the US, the tariffs, and one big beautiful bill, and other things that have an impact across the world. You know, how are LPs working this new reality with the volatility? People say markets are shut, you know, you can't make investments, you can't exit investments. How do you deal with this volatility?
Yeah, so happy to crack on with some macroeconomical considerations. So if we look at the last decade, all the tailwinds that had propelled the private market industry, so you name it, fiscal stimulus, quantitative easing, ultra low interest rates, they have completely flattened in the recent years, and we need to add on top the macroeconomical instability. So right now, one of the asset classes, and I think, well, happy to someone proves me wrong, but I think private equity is one of the asset classes that have experienced some slowdown. I think what we have seen is that this dislocation between funds in the last decade going into the market with double size in half of the time, because in 2 years they were already 80% committed, so they were ready to go into the market again, capturing all this liquidity that was present. And now a new set of funds that really struggled to raise money, and they are not ready to accept the party that we have in increasing multiples, and they are applying, of course, liquidity premia to the portfolio. So we have seen a dislocation. As a result, we have old vintages with an unprecedented backlog of open commitments and a backlog of also of unsold assets. And then we have new funds that are struggling to recycle the capital into the new funds. And of course, that they have a very slow deployment. So in that context, LPs are recalibrating their strategies, looking for strategies that can ensure lower duration, more liquidity, earlier exits, and at least from my perspective, yeah, happy to have my co-panelist with other ideas, but we really see infrastructure and private credit as emerging asset classes. I think private credit is spectacular. So we had, at least in Luxembourg, we started with the platform in 2019, and now it has exceeded all the other buckets of infrastructure and private equity. So we're talking about 10 billions that we have in Luxembourg from nil in 2019. So spectacular growth. I think private credit and infrastructure, they provide resilience, less volatility, more cash flow predictability. We shouldn't forget that infrastructure, right now we have all the willingness of governments pushing the energy transition agenda, the digitalization agenda. And then on the other side, we have also private credit with banks retaliating from the lending business, and also public budget under pressure. Sorry, I know I'm extending a little bit. Yeah?
You just didn't have the mic.
Oh, sorry. Yeah, then basically we also see as pivoting strategies emerging. We see secondaries and co-investment, precisely because all the reasons that I mentioned before. And I think on top, secondaries and co-investments, they flattened the J-curve effect, so you avoid the blind pool risk. And of course, we need to bundle this with the big momentum that we have since secondaries are often offering a very interesting solution for the backlog in open commitments, so LPs that are able to find liquidity for the positions in the fund, and also GP-led transaction or continuation vehicles that offer a very big solution for all these assets that are trapped in the private equity. Yeah, so in a nutshell, I think now portfolios construction is about liquidity and certainty. So all the asset classes that endorse liquidity and certainty, I think they will be definitely backed. I think portfolio constructions, it needs to be based on strategies that are able to navigate these choppy waters of the macroeconomical environment. We are very much focused on GPs that are able to focus on operational value creation rather than multiple expansion and leverage, which I think it was maybe the case in the last decade. So now we're looking for real operational value and efficiency. And as we always preconize in Allianz Global Investors, is the active management, right? Yeah.
Thanks. Irina, do you want to?
Yeah, I think on our side, we are, let's say, quite focused on remaining cautious and long-term resilience. And we've basically focused on that in building our portfolios. So our portfolios have very high-level diversification. Diversification in multi-areas, so from asset classes, sectors, underlying sectors, vintages, tenors, credits. So because of that, we are able to withstand, for example, more volatility in the market, more, an environment that, let's say, brings certain challenges. That being said, we're not complacent. We see risks popping up. We see pockets of volatility in different markets, in different sectors. So what we've been doing lately is making sure that the deployments that we do, the commitments that we do to our managers, to the funds that we invest in, we do not put the pressure of deployment. So basically, if we need to slow down deployment, that is totally fine with us. We're a long-term investor. We want a long-term value creation. And therefore, we see a lot of pressure on the market, for example, to money being put to work fast. We see lessening or loosening of terms as a result of that. We are not basically in favor of that. We prefer to remain cautious, to keep the quality up, the risk-return balance in our favor, and making sure that we work with parties that are disciplined in their underwriting, that keep the downside protection, and keep all these elements into mind. So yeah, it's been quite challenging, to be honest, because in terms of deployment targets, we needed to adjust those, and we need to adjust our assumptions and our expectations going forward. However, we see this paying off. We see, for example, the watch list not growing as fast or potentially even becoming stable right now as a result of the strategy we've been taking already before everything happened in the market. So yeah, in a good way and also bad way, we're trying to mitigate both sides.
Thank you. But you have the broader view from quite a few different LPs. What do you see?
Yes, I think just adding to what my great co-panelists have just shared, I think from, to your point, hearing from these various perspectives from LPs, sometimes you get into discussions about like things which are very current or urgent in this moment, also like geopolitically or the headwinds that we are facing. I think the common denominator between kind of like the very broad group of LPs that are our members or that we speak with is that they're very long-term focused. So in general, that means that they look at terms like Irina already mentioned, kind of like it's 10, 20 years ahead, which almost, it's not to say that they very much care about like what's currently going on, but kind of like factor into a lot of these elements to make sure that what works best kind of like in that long run. And it creates something of a less kind of like, I don't know, a volatile type of approach to things because there's a way out of where we are right now. It's a glass ball. I think nobody really knows what it will look like. There's definitely certain trends, we'll speak on that a little bit later maybe, which are here to stay. And we're also trying to keep pulse on all these developments, also with kind of like regulators, governments, how they are approaching these things, and try to educate and keep bringing relevant information. What would impact potential investments or strategies there?
Thank you. So you're right. I mean, we are, at the end of the day, we are in a very long-term asset class, and most investors, especially institutional investors, are in it for the long term. I think one of the challenges is the fact that having lack of liquidity, having had the denominator effect, a lot of people can't really commit to future vintages anymore. And so I think with that, what we obviously see is the upcoming of what we call retailization. There's actually this year an entire wealth channel module a little bit further down the hallway. As I think in a certain way, GPs are also looking to diversify their investor base because some of their existing institutional investors just cannot continue their programs given the whole market. So, Bart, what do you see there?
Yes, and I think it's spot on. Kind of like this is a big structural seismic shift, if you will, with the anticipated amount of retail capital floating into private markets. It depends on kind of like when we speak with certain members, they're concerned about it's a potential shift in dynamics in general between LPs and GPs, but also within those that are already focused on kind of like retail and those that are not. So what we try to do is educate kind of like the LP community. We'll be putting out a white paper, for instance, with practical questions for LPs and GPs to kind of like discuss between each other on this topic specifically to make better informed decisions. But what we keep kind of like saying, both to LPs and with GPs, make this part of your conversation. Don't wait. Even if you're not focused on it right now, and our latest, we do a lot of surveys, and our latest, let's say, LP sentiment survey, which we're actually have activated recently, but let's say the latest input we got there is also that there's a lot of LPs who are not yet invested in the retail focused GPs, but we're very proactive in saying like, look, you need to address this because it will come, and there's kind of like a big wave. But like one thing to finish is it really depends also on like what do you mean like with retail, right? There's different perceptions with that word or that phrase, which need to be require definitions to have a productive qualitative discussion, I'd say.
Yeah, it's certainly created a structural shift. Irina, from your perspective, obviously an institutional long-term private equity investor, how do you see this new investor coming into the market? How do you ensure that you remain right front and center of attention to GPs?
Yeah, no, good question. And to be honest, we play a bit of a two-hat role. So on the insurance side, as a publicly listed, regulated entity, you have certain regulatory obligations, certain reporting obligations, certain standards that you have to keep. And that also translates to the managers we work with. So we need a certain level of sophistication. So manager, GP, that is able to provide those, let's say, services to us, the reporting requirements and checks and balances. And we see that, of course, there is a bit of misalignment when it comes to focusing too much on retail investors, because those have different needs and different level of customization than we would have as an insurance company. But that being said, we're also looking into making more alignment between the two sides, and I think Bart's role here is very important because we also have a DC hat. So a defined contribution hat, more pension-related capital, that also needs to be invested. And historically, this has been mostly private market money due to liquidity aspect. However, we're starting to look more and more into private markets. How are you going to make that? Because you need that daily valuation, you need that liquidity, daily liquidity ability to get money out. And therefore, I think it's a bit more related for retail money, retail capital, that we could align with that and we could make it work through evergreen vehicles that are being right now, for example, launched. And so it's a balancing factor. Depends which side you look at, insurance or DC. So yeah, it's not a straightforward answer, maybe.
And Pedro, you also have two hats, basically, as a GP and an LP. So how do you... what's your view on that?
Yeah, that's correct. So on one side, we are part of the Allianz group that is investing as an LP, but on the other hand, we also advise our LPs, especially through the fund of fund channel. And so we are of course confronted to this dilemma. I believe that retail has represented a way to compensate the flattening of institutional inflows into the strategy. So of course, we welcome all retail investors, despite the fact they come with a very significant operational burden. I think we will hear a lot about this in the summit. So democratization of private markets comes with complexity. I think there is a lot of education to be done, as Bart said, because it's a new asset class for retailers. And on the other hand, they might get used to the simplicity of the passive product, right? So, and private markets is nothing as simple. So when implementing our products, we need to define which are the safeguards in terms of liquidity, how we protect the fund with gating measures, right? So there is a lot of back and forth to find the right balance. So liquidity, governance, regulatory compliance. So it's a lot of struggle not to get diluted in this value proposition and to succeed in this alignment. I think what we shouldn't forget is the fact that the big bulk of commitments is at the end coming from institutional LPs, right? So I think this is what guides at least our...
Yeah, I'd love to chime in there. And Pedro, I 100% agree. I think what's interesting, and that's what I related to before on the, let's say, concerns of certain institutional investors, like, hey, what does this mean for me? Because we used to be, or we still are, we believe we still are kind of like anchoring a lot of these projects, if you will. What does it do kind of like to the level of attention I'm getting? Do I have clarity on kind of like the full allocation or investments into certain funds with, various retail channels flowing in there as well? Education is obviously top priority for us, but I wanted to also like address this, that retailization is obviously a topic or a phrase that's being used a lot, but on the governance side, it's almost, we're working probably towards a retailization of governance as well. Because if we're, institutional space is obviously very much sophisticated, very professional, and there's different layers, I'd say, of sophistication in the retail space, which could be highly sophisticated to lesser sophisticated. It will probably require also a new set of almost a convergence between some things that we are used to on the public side, public markets, and related governance coming into our, let's say, more closed private market space. So that's something we find very interesting and try to be top of mind on.
I just wanted to pick up on this, the liquidity aspect of this, and you mentioned the evergreens earlier, and I don't know who wants to answer this, but do you see a potential, and I'm not saying it's necessarily a risk, but dilution, you mentioned dilution, dilution where institutional investors suddenly go, I actually quite fancy that evergreen product myself. Although I am in for the long term, and that is how historically I've done private equity, given the circumstances, having had these challenges with the denominator effect and having to rebalance portfolios, different investors have different approaches. Some just freeze their programs when we all know that you should be, constantly diversifying vintage years. Others have more leniency where they go, well, we're over allocated, but we're not going to stop the program because it's important to us. Do you see there a shift from the institutional perspective? I don't know who wants to start or answer.
Well, just a quick word on that. So I think the request for open architectures that we see, for example, in our multi-asset offer, where we're able to provide the full range of products within a fund, and even we are able to recommend internal products, but also external products. I think it fits very well with what you just mentioned. And this is also for institutional or pseudo-institutional investors that are requesting to have this flexibility. So I think open architecture and fund flexibility is not only a topic for retailers, but institutional are requesting more and more. So they're requesting SMAs, so strategies that can fit perfectly to their, well, to the market constraints or specific constraints. With the emergence of SMAs, evergreens, well, LTIF as well. So, yes.
Yeah, and I do recognize that, actually. We've been doing that already for a while, I would say. We call that a partnership approach. So we work with select managers that we're able to scale through, and we're able to be flexible, and they're also able to customize to our needs. These needs mostly refer to, for example, regulatory needs. So solvency, just as a quick example, Solvency 2020 is coming up. That's 2027 implementation. Anything that is foreign asset-based is more punitive in terms of capital consumption. So it could be that we like a strategy very much and a manager very much. However, they have a larger focus, or larger than we would like, focus outside of Europe. That is not really something we can absorb anymore from a solvency perspective. Therefore, that doesn't stop us, for example, to invest in the strategy itself, but we would need to carve out certain elements. We would need to maybe refocus more on Europe, and hence their commingled fund might not work. So then we would need to come up with a customized solution. The same with allocation targets. You want to be able to reallocate between asset classes, between strategies. You want to be able to upsize and downsize. So having more customizable solutions, having strong relationships, platforms that we build with our managers that really helps us achieve our ambitions. And I think a very good, maybe key point for us is also the sustainability angle. So that's even, I think, more key right now for European institutional investors than before, with the trend that we notice in US. And I think, as a large European insurer, we need to push the market forward. We need to partner up with managers that are able, that basically are committed and aligned together with us. So a lot of the let's say, solution-based vehicles that we came up with have a very strong sustainability angle. Whether it's a climate solution, whether it's an Article 9 fund, whether it's infra, whether it's real estate development. So basically that really helps, because if you have a good relationship with the manager, if you have the scale, if you have the closeness, then you're able to work together to solve a problem. Whether it's our problem being, solvency constrained, or whether it's a world problem, I think in the end it's all about working together.
Yeah, I think you mentioned something about the partnership with the managers, with the GPs, and I think that's the third sort of topic that we had identified in our pre-chats, in terms of what we see emerging a lot as a result of everything going on, is the concentration of managers, meaning that investors are veering towards having fewer managers and having more concentrated relationships with them. So how do you see this fostering partnerships? How do you approach this?
Yeah, happy to start with one example. So In infrastructure, we see a clear trend for concentration. I think the last figures from Preqin are suggesting that 15 GPs are concentrating 80% of the new capital, that I really find mesmerizing. I think in this context of uncertainty that I was referring to before, there is a surge from the LPs to look for GPs that they can really have long-standing relationship, strategic relationship. So the GP is coming like as a trusted advisor, and we are seeing even allocation emerging as a service, allocation as a service. Of course, this relationship is based on history, on track record, on delivery. And I think, yeah, definitely this is something that we are seeing. I don't know if my colleagues did.
Can you double click just 1 minute on the allocation as a service? Because I think that also impacts how, how the capital is being diverted from PE to private debt, infra, etc.
Yeah. Well, I mean, here I think we need we have specific platform. It's called Risk Lab. Therefore, we start first as an advisory, so we understand which are the needs of our clients, and then potentially we could also get a mandate in order to manage certain portfolios, right? But we help them depending on their sector-specific constraints and the macro constraints in order to achieve their goals. So just to give you an example, we can have one client that is looking to protect their portfolio, and they're just happy, same yield, less volatility. So they are not even searching more yield or more return per se. So they're just happy with less volatility. So, and of course, this gives us a lot of flexibility, and this again rebounds on what I was alluding to, that we have open architectures, right? So we are able to present private credit, infra, co-investment, external funds that we have a very strong relationship and we believe have a very good fit with a specific strategy.
Sure. Yes, like the angle I would kind of answer this was basically saying how sometimes it is so underrated in terms of level of partnerships between LPs and GPs, with acknowledging that there's kind of like a more selections being made by LPs in terms of selecting a smaller group of GPs maybe going forward, but how let's say GPs show up in that relationship, how proactive kind of like the discussions take place. What I said, like what is underrepresented, if you will, is how much of the quality in that interaction, being proactive, really treating it as a partnership model, what it is, actually makes a big difference in terms of the manager selection at LP level. What I'm trying to say is everybody comes with pitch decks, data, specifics, and that's all necessary, but there's also an element which is almost hard to put in really hard parameters, but it's there. And it's actually, that's also it's the heart and the mind to make a decision, okay, in my next selection, what would that group be? Will this be the same group of managers? Will it be this one because promised the sky, but delivered? And it's, again, I just want to reiterate the partnership element there, and you'd be surprised how much of that is can make the difference based on the proactivity and the partnership level of the discussion, regardless of differences in opinion. That's always good. It's people's just business. Have the conversation.
It's people's business, right? Irina, how do you approach this? Do you concentrate with fewer managers, and what type of managers would you then? Is it the pure players? Is it?
Yeah. I wouldn't say we're concentrated, so we do have a pretty good share of various managers that we work with, global, some of them more local. I think depends very much on the strategy, depends very much on what we want to invest in. So I think generalist managers or managers that are able to provide, let's say, core strategies, across the board. Yeah, we also have some of those for sure, but we also like specialist managers, so managers that are able to deliver something unique, that have basically launch strategies that are competitive, very hard to enter, let's say, that particular skill set by other parties in the market. So we also enjoy quite a lot working with those, also from growth abilities, so scaling up, education, learning. You know, a lot of people are looking right now into asset-backed financing as the direct lending 2.0. Well, that's also scalable, but only a few can actually do it right, or at least that's what we've seen, and even less in Europe. So we do think that it's important to look for where there is opportunity, but also at the same time have some strong platforms that are able to cater around different, let's say, skills and needs and knowledge and ability to invest more, you know, from a core perspective. So it's I would call it core and satellite, actually. I think that would be a nice way of presenting it in terms of how we select our managers and how we work. So yeah, I think concentration is not necessarily I mean, we try to manage that very well, but that being said, partnership is also very valuable to us. And I think to add to Bart's point, I think there are hard skills and soft skills. So, of course, how a manager communicates, how they provide insights, how they provide access to information, how they're proactively trying to, let's say, solve an issue that they notice in the market or with an LP. That's very, very important for us too. And of course, the normal hard factors such as cost, efficiency, and return, risk, and you know, all the things that are part of doing an investment, of course. So yeah, that angle of like more human, let's say, which is really hard to quantify, that's also very important for us.
You wanted to say something?
Yes, I can only echo what Irina just mentioned. I think the combination between general managers and pure player, this is also a cornerstone of our portfolio construction. I think on one side, global players, they give you some resilience, right? And exposure to different asset classes. And then well, this would be for the generalist. And then pure players can provide you the kicker that you would expect in performance, and it enables you to seize the momentum, right? And I think that's why it's so important to combine.
And it feels like we need both, right? We need the resilience, but we also need to make sure we deliver performance. I'm conscious of time. We have a couple of minutes left, so I wanted to give the chance to the audience. If there were any questions in the audience, we'd be happy to take them. If you want to run around with the mic.
Do we have a question from the audience for our panel? I'm just going to borrow Bert's mic. Do we have any question from the audience for our panel? Yes, sir. I'm going to come over to you. Let us know who you are and who you work for.
Hi, my name is Sanidhya. Can you hear me?
Yep, go.
Okay. My name is Sanidhya Agrawal. I work with ICG. Given the recent comments from Jamie Dimon and concerns around private debt, private credit, how are you approaching your allocation to this particular asset class? Are you reducing that?
So the allocation to which asset class?
Private credit and private debt.
Okay, so private debt. How are you managing your allocation to private debt?
I did not really hear the question.
I think it was about some of the stress that we've seen with a few deals recently in the market, not to name the company. You know, is there a stress in the system versus one-off? Are you revisiting? I think that's what I hear there. Are you revisiting your allocation? I think I heard from you that you're actually increasing allocation to debt versus private equity. But I think the question was, given what's been happening in the last couple of weeks in the market with some debt, you know, just basically being written off, is that making you reevaluate?
Well, so far, we are pretty much full capacity, as you mentioned. So we're looking into actually expanding other sectors of the private market, other asset classes. So we're growing our private equity, we're growing our infra equity, real estate also. So we did notice, as I mentioned already, some pocket of vulnerability, especially in CRE lending. So that's been in Europe quite hit versus, let's say, more direct lending. We are not really reallocating our private debt portfolio. We do think that we're highly diversified, but we are mindful of the fact that this has to be well monitored, and this has to be, if any inflection point, we need to take action. So again, we're not staying still. But in terms of reallocating, that's not. I'm not sure if I'm asking the question.
No, I think.
That's good. I'm afraid we've just got 30 seconds left for your panel.
Do you want to finish?
Elevator pitch. Well, basically, I think as an insurance company, we are very risk averse, you know. So I think there are still opportunities there in unitranche, direct lending. I don't know which case you are referring to. Yeah, but I think there are still opportunities out there. And of course, you always need to be mindful when the pendulum is coming back in order to reshuffle to new strategies. We also see that private equity is picking up, and directly also related to the slightly drop in interest rates. But yeah, that's something we need to remain vigilant. But for the moment being, we only see like increasing interest.
And I think that's all we have for you today.
Thank you very much. Can I have a round of applause, please, for our panel? Well done.